When most people think about investing, they picture something exhausting. You're staring at stock charts, reading the daily news, and trying to guess which individual company is going to be the next big winner. But you don't actually need to pick winning stocks or perfectly time the market to build long-term wealth. In fact, trying to do that is usually a costly mistake. This chart compares the returns of the general stock market to funds run by Wall Street professionals. On average, actively managed funds actually underperform the market by about 2. It is a single investment that pools your money together with other people's money to buy a tiny slice of hundreds of different companies all at once. Think of it like a VIP list, the S&P 500. It's the top 500 largest public companies in the US, and it manages itself. If a company does poorly, it gets kicked off automatically, and a new successful company takes its place. If you buy a single share of one company, and that company goes bankrupt, you lose your money. But when you own a slice of 500 top companies, one bad apple won't ruin your savings. This approach is so reliable that billionaire investors like Warren Buffett recommend it as the absolute best strategy for everyday people. I will warn you, this method is boring. You aren't going to get a daily adrenaline rush checking your phone, and it is definitely not a get-rich-quick scheme. But that boredom is your secret weapon. Because you own the whole market, you never have to read financial reports or stress over the daily news. You let your money grow in the background on autopilot. Getting started is surprisingly simple. Step 1 is to open a standard online brokerage account. You can do this in minutes with trusted companies like Vanguard, Fidelity, or Schwab. Step 2, once your account is funded, use their search bar to look for a broad market index fund, or an exchange-traded fund, often called an ETF, that tracks the S&P 500. For example, this image shows what it looks like on a trading screen. You can see the ticker symbol SPY, which is one of the most popular funds tracking those top 500 companies. Step 3 is to click Buy, but before you finish, make sure you look for a checkbox that says Reinvest Dividends and turn it on. This is crucial. A dividend is simply your share of the profits those companies made that quarter. Reinvesting means the system automatically uses that cash to buy you more shares, which earns you even more dividends next time, creating a massive snowball of wealth. By completing these steps, you have officially stopped being a bystander. You are now a partial owner of the American economy, and millions of employees are going to work every day to make you money. There is one hidden trap you need to watch out for. It's called the expense ratio. This is the yearly fee you pay the company running the fund. Because an index fund just runs on an automated list, they don't have to pay expensive stock pickers. That means your fee should be incredibly low, usually just 3 to 5 cents for every $100 you invest. This chart projects investment growth over 30 years. You should never pay a 1% fee to an active manager, because as you can see, that tiny percentage pulls away hundreds of thousands of dollars from your final total over time. You have to remember that this strategy requires patience. The stock market will have bad years, and your account will go down sometimes. You have to ignore those dips, because you are building wealth for decades in the future. You don't need a finance degree to be wealthy. You just need a simple, low-cost index fund and consistent contributions, and the patience to let time do the heavy lifting. If this gave you one thing you can actually use today, subscribe to Cents and Strategy for more practical breakdowns on money, habits, and smarter financial strategy.